Morning, folks. This is just the world we're in is moving very quickly. The slides were sent at, I think, 3:15 yesterday, so that means they're probably out of date already when it comes to currencies and interest rates. I've got 35 minutes and a good few slides to get through, so if you're not awake, you probably will be in 40 minutes, probably because I'm going to scare you. We're going to cover a number of different topics. Going to start with the macroeconomic overview. I'll only cover a couple of things there because Jim is going to talk about that in a lot of detail in his speech. We'll then move on to foreign exchange, interest rates. We'll speak very quickly about funding developments. Again, I'm only going to touch on it tangentially because we have a panel discussion subsequently to me talking about other sources of funding, which I think is going to be very important going forward. There's one slide in sustainability, not because it's decreasing in importance, but again, I think Jim will have stuff to say on that, and then we'll just try and wrap it up, okay? So what we're going to do is, while the slides are coming up, don't worry about that, I'll talk anyway. The macroeconomic overview. So first I'm going to look at global trends. I'm not going to spend 30 minutes talking about Trump and tariffs and stuff, but if you just look at where we are in a broad sense at the minute, economies are generally slowing down. So GDP, most recent GDP readings were 0 in the EU, 0.1% in the UK, 2.4% in the States, and 3.7% here. Unemployment generally, globally, is pretty good, between 4 and 6%, so that's okay. Inflation coming down, but still not necessarily under control. For example, it's still 3.5% in the UK. But the debt to GDP is one of the things I want to focus on. I've been going on about this now for a couple of years, the debt levels in particular and the deficits, because the debt to GDP in Ireland, if we actually use GNI, is about 72%, okay? It's about 63% in Germany, it's 95% in the UK, and it's 122% in the States. Their debt is 122% of GDP and has been growing just massively over the last number of years. And again, we'll cover that in a second. And of course then, the knock-on effect in all this is that when you have high levels of debt, your interest costs are obviously higher, and then if interest rates are going higher on top of those interest costs, you get a compounding effect almost there. If we're looking forward, because PMI readings, they're the sort of things that look forward as opposed to GDP and unemployment have been lagging indicators. A reading of anything in the PMIs above 50 says expansion, a reading below 50 is contraction. EU manufacturing PMI at the minute is 48, so it's contracting. The figure in the UK is just under 45. It's about 50-ish in the States, and they're the most recent readings. I suspect they'll be worse when we get the readings in the next month or two, because consumer confidence is falling as well. And if you think about GDP, if any of you did economics in either for Leaving Cert or for college, you know, it's consumption plus investment, government spending plus exports minus imports, okay? Consumption is people spending money, and if consumer confidence is falling, that means that's going to ease back. Investment, we know so many multinationals and companies are holding back on investment now because of the uncertainty, okay? So that's falling. Government spending is probably going to have to rise, partly because of defence issues and stuff like that in Europe, and partly because of infrastructure. Is probably we haven't spent enough in infrastructure over the last number of years as well. But then you have the debt issue there. How much can they borrow? So you can see of the variables in GDP, a lot of them are under pressure now, which would tend to point to an economic slowdown in general. And if you think about just deficits for a second, the States has basically run a deficit. So what I mean a deficit is you look at your tax revenues here, your revenues, and you have your expenditures, okay? So if your revenues exceed your expenditures, you've got a surplus. If you spend more as a government, then you actually you have a deficit. The economic theory is that you should run deficits when economies slow down. Why? Because governments need to spend more then, and also because obviously their tax take falls and their social welfare payments and things rise, okay? But then it should flip the other way when economies go well, because your tax take should be high and you shouldn't have to spend as much on things like social welfare. The States have been running a deficit since 2002, consistently from 2002 to 2024, okay? And just to give you an idea of the scale of their debt, their US government debt in 2000 was 5.8 trillion. In 2010, it was 14 trillion. In 2020, it was 27.7 trillion. And in 2024, it was 36 trillion. Okay? So basically, if you run a deficit every year, the only way you can fund it is to borrow. It's like you earning 30 grand and spending 40 grand a year. You're borrowing 10 grand a year. And eventually, can this keep going? Now, they've been able to get away with it because the dollar obviously is reserve currency. They can print dollars, and that's basically how they fund it. They print dollars to fund their deficit. But you would have seen gilt interest rates rise significantly in the States in the last couple of weeks. And for the first time, analysts are saying there's a political risk premium in interest rates. Okay? Now, political risk premium normally arises in emerging markets. Why? Because they could be coming out of dictatorships or military coups or something like that. But you're actually seeing 45, 50 basis point rise in 30-year yields in the States. And this is the black swan event, potentially. Their debt is enormous. And I guess saying things like Trump threatened a couple of weeks ago, because a lot of their debt is maturing. They have a big wall of debt maturing in the next couple of years, and the same in the private sector as well. He has suggested, and at one stage I think he said, do we owe this money? Not a great thing to say because it spooks the markets. And somewhere along the way, he also suggested they might do a debt swap. In other words, if you've got debt maturing the next 2 years, you might swap it for bonds instead for 20 or 30 years. Now, if you do that, you'll get away with it once, but you won't get away with it again. And an awful lot of the holders of US government gilts are foreign. Japanese are the largest holders, the Chinese are the next biggest holders, and quite a lot held in Europe as well. Okay, so you can only fund your deficit if people buy your bonds. And this is where some of the tariff stuff might play out as well. Because if you don't have, if people from, for example, from China or from Japan or from Europe decide not to buy bonds, you have a failed bond auction. If you fail bond auction, you have a major problem, okay? So that's the thing I think we're going to have to watch in particular. In Ireland, just one thing to note, and again, it's very important. We've been running a surplus for a number of years, but we've had, as you know, there's been a lot of talk about the one-off tax take from the multinationals and that. Department of Finance issued a publication last October for the budget, and they noted that we had a surplus, if you include the Apple money, of about 22 billion last year. But if you strip off what they call the non-recurring, or I'm going to call them the supernormal profits, and what is the actual level of deficit or surplus, they're actually saying we had a deficit of 6 billion last year. And in 2025, they're projecting an actual surplus of 9 billion, because that's what we think we'll get from corporation tax. But the underlying position, if you take that one-off stuff, is again a deficit of 5.7. So we have the Department of Finance are effectively saying, yes, we're throwing off cash, but in actual fact, that cash is not sustainable. And if you strip that of it, we're actually running at a deficit. So you can see there are challenges all around in that regard. And the last thing, I suppose, on the government gilts and stuff like that is just to put again in perspective. The States, Germany spends 1% of its GDP on its interest costs because its debt is relatively low and interest rates are low. The UK spends 2.9% of its GDP on interest costs. The States already spends 4.7%. They spend, I think, or they will spend as much this year on interest as they will on defence, okay? So this debt mound that's there is a massive problem. It's a huge problem. But the problem is if it goes wrong for the world globally as well. So it's a particularly sobering thought. So in summary, macroeconomically, what we're saying is economies are slowing. Demographics, I guess, in the Western world are going the wrong way. Birth rates are falling and populations are ageing. Poor growth in the UK, for example. I think in Ireland, look, first of all, I think the macro stuff is good, but we have a lot of money to spend on infrastructure. We do have a lot of revenues that are one-off in nature. And we've got challenges, as I said, on a number of different spaces. UK growth was only 3.4% between 2019 and 2024. They also have government debt, as I said, at 95%. They've got challenges over there too. Productivity is quite low. I mean, we know what the problem is with the States. And I think the key issue for the States, and the key problem for them, is that the damage that he could do, even if he does a deal on the tariffs, and he is a wheeler and dealer, the trust and confidence thing is the big problem. Because confidence is hard won and easily lost. And I think that's going to be the big challenge for him. So the outlook right now is, the tariffs need to get sorted because it's not great. And again, one final little bit of trivia, as it were. China manufactures more than the States, Japan, Germany, and South Korea put together. Okay? So, if they don't sell to the States, they've got to sell somewhere else. And in actual fact, 70%, I think, of the economy in the States is based on services anyway. So, it's a mad situation that we're in at the moment. I hope it settles down. But it would be, crystal ball gazing in this scenario is impossible. But generally right now, you'd say we're in risk-off mode. Economies are slowing. And I think we just, from a financial perspective, we just have to tighten our belts and monitor things more carefully, okay? Moving on to interest rates. So, in general, interest rates, as you know, have been falling for the last while. We have had So the base rate peaked, base deposit rate, ECB base deposit rate peaked at 4%. It's down to 2.5%. There's a ECB meeting again this week, and it will, I think it'll be cut. It's almost nailed on. It'll be cut to 2.25. Now, initially at the start of the year, we thought it might bottom out at 2%, but now it looks like we could have 3 or 4 cuts. So the current view is that the ECB rates, we have movement. We have, great. I've done all right, haven't I? In fairness, though, without the slides. Okay, I'm not going to go back over the graphs, but we can send the slides around afterwards, Paul, can't we? That's the States one, just there, the deficit. Okay, that gives you an idea. In fact, their deficit in 2024, outside of COVID, was the largest it's ever been. It's mad. Like, when you think about it, you wouldn't run a GA club like that in some respects. Okay, maybe you would. I shouldn't say that. I've been involved in some GA stuff myself over the years. I better say nothing. They're the gilt rates. I'm going to quick move on because we've covered that. Okay, on the interest rates, I needed this. Thanks be to God. Right. This is basically saying what the interest rates are from 1 up to 40 years at the minute. So we've got euros, sterling, and dollar. The key thing to note is, so when you're looking at interest rates, basically, if you draw a line or a curve from the short term to the long term, most of the time the curve goes upwards from left to right. Okay. In other words, shorter term interest rates should be lower than longer term rates. When that happens, that's what we call a normal curve. In maybe about 12 months ago, it was going the other way. In other words, rates were coming down, so interest rates at the short end were actually higher than at the lower end. This is kind of normal service resuming of sorts, which is telling you that we're coming to the bottom of an interest rate cycle in the next 12 months, and therefore you'd expect things to maybe increase slightly again. If I move on to this one here, so this is the 3-month Euribor, okay? And Euribor is... it's basically, this follows the ECB base rate, okay? So the ECB obviously only move in chunks because they only meet, they don't even meet 12 times a year. And actual fact, although we're here in April, ECB only has 6 meetings left this year, okay? So only 6 opportunities of which to cut, and I think I said they'll cut between 3 and 4 times. You can see the Euribor rate, because that gets reset every day, that's at just over 2.25%. Why? Because we've a meeting this week and they're expected to cut from 2.5 to 2.25. So you can see the trend on the bottom here is the negative rates that were persisted for the last part, or for the latter half of the last decade. We got the climb here after COVID, and now it's easing back again. And this is what you call, I guess, a normal curve, bottoming out somewhere between 1.5 and 1.75%. The swap rate, so don't worry about the terminology. Swap rate is just if you wanted to fix in the markets for 3 years before any margins. This is the interbank level. You can see that's a lot choppier. That's only for this year. And what I wanted to highlight here was the volatility, I guess, of it. The fact that so the vertical lines here are the movements in the day, okay? So the small squiggles on each line is the opening and closing rates, all right? So you can see, and the reason why I put that in is I want to give you an idea of some of the volatility even within a day that's been happening in the markets in the last while, okay? So what you're basically seeing is the swap rate rose at the start of March, again in reaction to worries about uncertainty, Trump, etc., etc. And I guess now because tariffs have been put, the fear that economies are slowing down, you got the swap rates coming back down again. And that's really the expectation that you're going to have contraction in GDP and therefore slowing economies and therefore swap rates coming down as a result, okay? On the outlook for the 3 different base rates, as I said, ECB, I think, will bottom out somewhere between 1.5 and 1.75 this year. That would have been envisaged to be 2% at the start of the year, but I said they're focusing on extra cuts now because of what's happening in the States. Similar really in the UK, at the start of the year they were expecting 2 base rate cuts. The base rate's 4.5%. They're now talking of up to 4 cuts in the UK. The States, you're getting a mix of views, okay? So there's certainly some people saying you need to cut because the economy will slow. You have others saying that these tariffs, if he comes through them, is going to drive inflation up significantly. And if it drives inflation up, the Fed is going to have to hike. So the debate now is, do this hold steady for a longer period of time or not? So very hard to predict what might happen in the States simply because of the volatility and the unknown element of the tariffs, okay? But for us in Euroland, you'd expect short-term rates to come down again, which is good news for businesses in general, variable rate debt, mortgage holders, etc., okay? I'm watching the time here because I am racing through this because I'm trying to get as much information to you as I can, all right? Okay, we're going to just look at 2 currencies, euro sterling and euro dollar. First of all, this is the 10-year trend. in euro sterling, and you can see, so basically 2016 is Brexit, okay? Now Paul's invited me back here because the first gig we did was in the end of January 2016, and basically what was happening is this volatility the vote was coming in June. The uncertainty was a 50-50 vote. It wasn't priced into sterling. Sterling was at 72p at the time, and I said that morning, this is going to 80p by June. It was at 80p by March. And Paul said, sure, you can do this every year, come back and just tell us what's going to happen. He sets the bar very high is all I'm going to say to you. But you can see that, you had literally sterling was at 72, 73p, hit 85p very quickly, and went higher. And we can see we're in a channel here now. Since about 2020, channel is narrowing, but kind of between 81 and 87p. It's holding at the minute. Touched against it recently, but came back down. I think we'll see where this will go. I think myself that that the movements, and you'll see in a second, have been very rapid, and that channel I think should hold for a while, because you could say nowhere is going well in the next while, because the States slows, Europe slows, UK slows, everywhere slows. But that channel is key. A breakout, and at the minute more likely to be above 87. That's where that will be a significant move in sterling. And the dollar, if I look at the dollar. This is the year-to-date one again. You can see the movement that's been there so quickly. I mean, we've gone from 83p to 86.5 in the space of about a week, 10 days. It's a massive move. If you're an exporter to the UK, that's a big dent to your profits if you have a hedge position. That's an enormous move. And actually, if you look at this one, oops, are we gone again? It doesn't matter. I have looked at the highs and lows. So I look at the volatility every year as well as the averages. Here we go. Oh, let me get this again. Oops, sorry, go back to that one. There we go. Right. What I'm showing here quickly is the highs, lows, the difference between the highs and lows. So that gives you an idea of the volatility every year and the average for the years. What you'll note here is that we've had the volatility in quarter one has been as high as the volatility in all of 23 or all of 24. So it's already more volatile in that context, okay? And the average rate, I think, has been very good last year, the last 12, 18 months for exporters to the UK. I think we're not going to get that rate this year. I think we will be seeing higher levels, okay? So we want to watch that. So I'll come back to, the outlook for sterling very quickly said I think the sterling range will hold for now. The markets, though, are focused on government debt. And this is a funny thing. Markets focus on different things at different points in time. I remember working in the IFSC back in the early 90s, and government debt was the thing. They all focused on government debt. And then they moved to something else. It's a kind of a lemming mentality. But I think if they focus on government debt again, the States is in trouble, the dollar's in trouble, and so is sterling, if that's where the markets go, because their government debt is so much higher than other parts of the world. On the dollar, if you look at dollar, the euro dollar, again, much more volatile actually than euro sterling, just to note, okay? The high-low movement in, let me just get this, hold on. Oh, come back here for a second. There we go. Let's just look at that's the trend for the last 20 years, okay? I suppose what I just wanted to say here is come back quickly. What I wanted to say here was that, we're at 113, 114. Comparatively speaking, like we've had dollar up at 140, 150, okay? So the idea that it's been quite a narrow range, narrowish range of 1 to 120 for the last number of years. It has capacity to go to at least 120 and further, I guess is what I'm saying. And we've already seen it move 12, 13% in 3 months, okay? So it's a lot more volatile because of, again, what's happening in the States. And I think if we look at where the currency outlook is for it, I'd say, a weaker dollar is probably good for US exports if you think about it, because it makes imports more expensive. It would be bad for us exporting to the States. Also bad for tourism here. Remember that, because we've had a lot of American tourists over the last number of years. They're literally getting great bang for their buck. If you see the dollar moving 15, 20% weaker against the euro, their spending capacity decreases. Therefore, you'd expect tourism business to decrease as well, okay? Weaker dollar tends to be good for energy because oil is priced in energy. Oil prices have come down from about $80 a barrel at the start of the year to $64 a barrel in the last few days again. So again, there's some positive news at least there. Price of oil is coming down and the price of it in euros is coming down with a weaker dollar. The key thing here is, for the first time, is the role of the dollar globally as the reserve currency has been spoken about for the first time ever, okay? And if the dollar was to not have that role, it has severe implications for the States, but probably has a knock-on effect globally as well. So what I would say is that In that context, the role of the Fed is also crucial. You've seen Trump has come out trying to put pressure on the Fed to cut rates, and they're supposed to be independent. And the other thing is that the Fed has always stepped in globally. Central banks globally have coordinated together when they have when crises like COVID and that. If we were to have another crisis and the Fed decided not to cooperate, with the ECB, with the Bank of England, Bank of Japan, etc., there will be other implications again. Thank you, Paul. It's only water. It's nothing stronger. I might be having that afterwards. The Cork Wine Society, I think, is next door or something. Thanks, Paul. So again, I think the dollar could go to 120 and beyond. At the minute, there's so much uncertainty there, and just markets don't like uncertainty. So I think there's risk that it can go further. Okay. Again, predicting currencies is hard at the best of times. In the current environment, it's virtually impossible because it's not economics that's driving it now, it's politics. And the politics is driving the economics, which is driving the markets. And given that we have a political situation where it does appear that I won't say it's been made up as we go along, but it's quite volatile and quite uncertain, that makes that whole scenario. But the one thing I can generally say is currency markets don't like uncertainty. And that's why you've seen a sell-off in the dollar already. And I think you could see more sell-off in the dollar if they don't sort out their tariffs, okay? If I move on then to funding developments, and again, I'm only going to speak a couple of slides on this. We have a panel discussion on funding after this, and they'll cover that sort of stuff in a lot more detail. But again, just to give you maybe a couple of figures, I have a slide that I used certainly when we started talking about the financial crisis first, showing the level of debt, corporate debt in the market, okay? So central bank data, this is, it's widely available. You can get it yourself. You can check it up if you want to. Obviously, you have a better life than I have because this sort of stuff I do check. Clearly, you're not that boring or that bored with life. But I can tell you that the level of debt in the corporate market was about 30 billion-ish at the turn of the century, 2000, okay? It hit 160 billion by 2008, of which about 100 billion was property related, okay? The same figure for corporates now, this is Irish corporates only, so Irish corporates, whether operating here or abroad, it's not companies operating here in Ireland, okay? So purely Irish corporates. The level of debt at the minute is down to 35 billion. So think about that, we had 160 billion borrowed in 2008, it's down to 35 billion now. And that's back to about 2001, 2002 levels. And if you adjust for GDP, adjust for inflation, you could argue we're back to probably late 1990s level of borrowing. Now, in one sense, that's good, because obviously companies are not indebted anything like they used to be. I would argue that that's too low. You need a certain level of investment in the economy, and I would worry that the effects of the financial crisis are still permeating today, and as a result, companies are only funding almost what they can fund themselves out of their own resources and funding a certain amount with debt. But I think there could be an argument made that we've underinvested at this stage, and that shows that it's underinvested. And if we just look at the SME part of that as well, if you take the level of debt in 2010, so post-crisis has been 100, it's 42 today, okay? So it's less than half again. So it's across the board, across all sectors, the level of debt has diminished dramatically. And that will be seen then in the bank's balance sheets, okay? So I had a quick look at the bank's balance sheets yesterday. At the end of 2024, AIB, I think, had 69 billion in loans outstanding, 109 billion in deposits, okay? And they were the other way around in 2008. They had to borrow in the interbank market, all the banks, because their deposit base was so low. Bank of Ireland had 83 billion in loans and 103 billion in deposits, okay? And PTSB had, I think, 24 billion in deposits and 21 billion in loans. So every one of the banks have more deposits than loans. And I said it's the complete opposite of where we were in 2008. So their credit ratings are good here. The three banks they're much better than they were, and they're solid. Their capital ratios are good. The banking sector, the problem is it's too small, okay? But they're in what's there is in great shape, all right? The lack of competition it could be a challenge, and I think even privately they will admit that themselves, because competition is good for us all, it drives us on. The other challenges in this space, I guess, is that, I suppose, credit. Risk departments are really calling the shots more and more, and credit departments seem to be risk off rather than risk on. So the level of leverage generally that they want to lend against is low anyway. You can see a push towards automation. I would argue that automation of bank lending practices is not a good idea. And the reason why I say it is because anybody who in banking over the years will tell you, you lend as much to the person as the company. You know, in other words, if you want to come in and you want to make a loan application, I could argue we could make the numbers work, but the question is, does the story stand up? And quite often, the story has been told by, you know, somebody who drives a business. And, you know quite often from talking to that person, whether they know the business, they know the sector, they're committed to it. You can't get that across on a spreadsheet. So I have a very firm view that lending is part science and part art. Okay? The science bit is cranking the numbers. The art bit is, do they make sense, and are they in the right sectors, and do people really, can they drive the business? A move to automation of sorts using AI, which I think is coming for loans. I think we could see this sort of automatic, the computer says yes or no stuff for loans of up to $1 million in the next 2 or 3 years potentially. I don't think that's a good development. I can see it's a cost-efficient development from a banking perspective, but I don't think it's a good development in general. The other thing too, I guess, and the banks are also, they're still subject to a lot of regulation, an awful lot of regulation, and regulations continuing to increase. And Willie Madden's going to fall off his chair, because I have a lot of sympathy for the lending people, despite spending 25 years negotiating with them. It's a hard sector it's a hard job in a bank now, because they've cut back resources. They're definitely under-resourced in lending, I think, across the board, driven by cost considerations. As I said, credit are calling the shots. And if you think about it, even at macro level within the bank, if you have more deposits than you have loans, I mean, literally, if you can pay 1% on deposits and put it on deposit with the ECB for 2.5%, you make it 1.5%, no risk, no capital allocation, easy money. And then you're going in as a lending person, and you're going to, you look for a margin of 3 or whatever it is, 3.5%. There is risk, there is capital allocated, and you're fighting against that other deposit thing. It's not an easy situation to be in. So it's and that's where I think the non-bank sector and the private credit market have a gap to fill, and I think that gap will continue to grow, quite frankly, which is why the next session I think is going to be equally important, because in a market where we have only 3 banks, that non-bank bit becomes more important. Okay, and as I said, so overall, I think what I would say to people on the borrowing side is start early. It's taken longer. Okay, it is taking longer. So if you need money in 3 months' time, start now. Don't start thinking about it in 6 weeks' time. The quality of the information is very important. The ability to, I suppose, share information. See, you got to understand at the end of the day, a credit process works like this. You have to give information to a relationship person in a bank who sells your story on your behalf to the credit committee. The more information they have, the better informed they have, the more likely you're going to get a positive result. So the idea of not telling them stuff doesn't work. It doesn't work for you, never mind for them. Okay? So you do have to focus on relationships. They are worth investing in. And as I said, at the end of the day, bankers want to lend because they don't make money and they don't survive, they don't lend. But I think that bit of linking in, sharing information, and I suppose good quality information is important, okay? One thing on sustainability, I've only one slide. Picture it in your head. It says 3 points. One is drive on or row back. Sustainability has kind of come on the agenda, come off the agenda. Jim's going to talk about it, I know, in a lot more detail. A lot of it was driven by CSRD, so the requirement to report on sustainability. EU has rolled back on that in the last number of weeks, okay? They've had an omnibus package, which is basically scaling back the reporting requirements. If they scale it back, then does that mean the pressure comes off? So the key thing is, did people see sustainability as a compliance issue or as a strategic issue, okay? And if you see it as a compliance issue, people will come back from it. If they see it as a strategic issue, they'll keep going. For SMEs, where you still got to watch it, is if you're part of a supply chain and somebody in supply chain has CSRD or other sustainability requirements, they're probably going to demand of you. So therefore, you may not have a compliance per se in a legal sense, but you will have a compliance issue in a commercial sense. So again, you need to find out if someone in your supply chain that's crucial is likely to come back. Practical implications, finally, to me, the obvious ones are insurance straight away. Okay, the banks did a mapping. I know Bank of Ireland 2 or 3 years ago in their annual report did a mapping exercise of Ireland and the UK for flood risk. Okay, because obviously if you can't get insurance, you probably won't get a loan for a house or a building. And actually, if you have it now, and your insurance suddenly disappears in 2 or 3 or 4 years' time because suddenly there's a flood risk or whatever, now you have a bigger problem because you've got a loan and you've got no insurance. If you have no insurance, you have a default under your bank agreement, because every single bank agreement has an insurance clause that says you must have your insurance up to date. I did a sustainability course, the Institute one, the certificate one, just there at the start of the year, and there was a model on UCC, and they modelled Cork and Dublin for a relatively modest increase in sea levels, and how it basically how it changes the landscape. And it's quite frightening, to be honest with you. As I said, if I'd had more time, I would have put 1 or 2 slides on that sort of stuff. But we do have to start thinking about, insurance in particular, infrastructure, all that sort of stuff. Sustainability is going to have an impact on us one way or the other. And I suppose the challenge now is to think, how do we link it into our business and make, because it's not just coming down the tracks from a compliance perspective or from a best practice perspective, it's going to bite. And I think the insurance space is probably the area where it's going to bite. So the last summary, I think I'm doing okay time, it's only just about 35 minutes. So summary, status of the UK or the US is changing. We have a new world trading order. Basically the norms that have persisted since World War II are now been broken. Okay? And what does the new world order look like? We don't know. I mean, America sort of have a North American, South American kind of aspect to life and worry about that and leave, Europe here and leave China dominating over here. I don't know. I mean, he seems to have it in for China more than anybody else because he's doubled the tariffs there again when he's rolled back on everybody else. But it just seems that it's a state of flux, and I said I'm sure Jim will talk about it in a lot more detail. But if it changes in the States, it's going to change for everybody because their global role is enormous, and B, the interconnected nature of global trade is such that if they change things there, it has to have a knock-on effect on us. The base rate in the Eurozone, I think, will be cut at least 3 times in 2025. Sorry, 3 more times, possibly 4, depending. Foreign exchange volatility, I think, is going to persist, mainly driven by political uncertainty. And I think foreign exchange is always the funny one, because as I said to you, it's impossible to predict, but it's also probably the most volatile piece of our P&L, okay? Because literally the price of FX moves every minute of every day. And I think it's still the most undermanaged part of finance, to be honest with you. Because most companies here either import or export, one way or the other. And we're indirectly exposed to foreign exchange through the price of oil, through the price of commodities, all that sort of stuff. So it has a way bigger impact, I think, than some people think. The bottom line on currency hedging for everyone here is, look, you're never going to beat the market, okay? Everybody wants to know, is sterling going up or going down? Where do you think it's going? There's traders who have 6 or 7 or 8 screens in front of them who trade currencies every day. And think about it, for every winner, there's a loser. Yeah? So 50% of the traders in the world and all the investment banks are not making money. So why, we making widgets think we can do better is madness. Focus on your margins, okay? I'm sitting on a board of one company. We put an FX policy in place because we have fairly big exposure to euro sterling, and it's very simple. Our gross margin is what's very important because we're buying stuff in the eurozone and selling it in the UK. So the key thing is managing our gross margin, because we know if we manage our gross margin, our overheads generally we can control, we can hit our EBITDA numbers, okay? So forget about beating the market. What's the FX rate that you need to beat, okay? What's your target benchmark rate, and just hedge around that. Don't worry about, because the arguments I've had over the years about, you're after selling sterling at 85 and now it's 82. If we'd done no hedging, we would have been better off. Yeah, that's great telling me now, but you should have told me that 6 months ago when we were going to hedge. Nobody knows, now what's going to happen in 6 months' time. In 6 months' time, everyone will tell you they all knew the dollar was going to 120 or back to parity, yeah? So don't try and beat the market. Just keep it simple, protect your margins, but have a process in place, okay, on currency. Bank lending, in summary, I said it's veering towards risk off. Loan applications will take longer. They do have to lend, but you will have to work with them a bit better. I'm certainly noticing a lot more questions coming back, and I think that's because it's coming back from credit and risk people again in the bank. But as I said to you, the quality of your information, the quality of preparedness will be very important. And as I said, our next panel, I'm sure, will share some light as well on the alternatives that are out there and what options you have. The key, in general though, on a macro level, economic slowdown does look likely because of all that's happening, because of confidence, because of, I said, everything just been put off. Investments on hold, consumer spending holding back. I saw even yesterday, I think on RT, they were saying that the holiday bookings are way down. People are holding off at the minute booking even this year. That's just consumer confidence again, not sure, okay? And for me, the US government debt is the black swan, okay? Did anybody ever read the book, The Black Swan? No? Somebody told me, somebody said years ago, you should read that, you'd love it. It's financial markets and it's philosophy and it's great. I brought it on holidays. We were sitting down the first day by the pool and freaking, and my wife says, how's your book? I said, I need a highlighter for starters. I said, I need to read it about twice. She said, why? I said, I'm on holidays. And I said, yeah, in theory it's interesting, but your man is trying to disprove how a normal distribution curve doesn't apply to tail risk in financial markets. That's not really reading for holidays. But basically, the theory of the black swan is that, there are 1 in 30-year events, and they have a small chance of happening, but if they happen, their impact is enormous. Now, of course, the problem is the interconnected nature of the world shows the 1 in 30-year events now seem to be 1 in 10, 1 in 5-year events for starters. And secondly, as I said, if they happen, it's big. And as I said, I have been going on about the US government debt for 2 or 3 years because it just doesn't make sense to me. And I think it is the black swan. If it goes wrong, it will go wrong very badly. But if it goes badly wrong for them, it's going to go badly wrong for everybody. So hopefully some sense will prevail. And, we'll come back next year, Paul, and things will be on the up again. So I'm glad you enjoyed my talk. And the slides will be available afterwards. But I think I've explained pretty much all that I need to explain. So I'll take questions. Well, I think I'm over on time, so I'll take questions if you want to, or otherwise I'm going to be hanging around after it. So, but thank you for your attention. Okay.
Just a quick question, John. Can you hear me? Yeah.
Yep.
I couldn't agree more with what you're saying in terms of prudence around managing foreign exchange risk and protecting your margin. And I'm just curious, obviously I did that back in the day, advising companies. And I remember always quoting a stat that 96% of the volumes of FX traded daily are speculative. Only 4% relate to trade. And you said yourself there that it's politics and economics that are driving the volatility. But is speculation, I mean, we think about the likes of George Soros back in the day and big players that were actually moving the market. Mm-hmm. Is that, I'm a bit disconnected from it on a day-to-day basis, is that still a factor?
It is huge. And the thing is, dealers, which you're talking about when you say speculating, I mean, they're dealers in investment banks, global investment banks, where they trade currency, so they look to make money. They love volatility. They don't make money when you have quiet times. They only make money in volatile times. But by definition, then, that almost encourages volatility because you get bigger bets, in and out. So it's happening, and it almost becomes a compounding effect because if you have political uncertainty, that drives the markets, a bit madder in the first instance. And then if you then have the traders then now are going to be trading more because they see opportunities. But I think it's statistic, it might be 90-10 or something like that, but I think the last time I saw it, it's still of that nature. Yeah, the trading bit. And sorry, the other thing I should say to you too is that, most companies don't have a policy in terms of foreign exchange and treasury in general. The policy is just a couple of pages. You should do it because it puts structures. Because what it does, particularly if any of you here are CFOs, you have 2 reasons for doing it. Number one, it's best practice and you should, and it gives you guidance as a CFO as opposed to guessing what a board might like. Secondly, it covers your backside in case something goes wrong. Now, I'd prefer if you did it for the first reason rather than the second. But also remember, for boards, anybody who's on a board here, you are responsible for risk. You have a legal responsibility to manage the risk. And, that's a fundamental part of risk. So having a policy in this space, it's not about, you don't need a huge policy. Just sit down. Most of you are probably doing the right things anyway, okay? It's just a matter of documenting it. And it's funny, when you put stuff down on paper and you actually probe it a little bit, you always find, why are we doing that? Why are we not doing that? You get a better outcome. But I mean, it's a good idea to have discussion around it. Because I said, you can't second guess markets in terms of interest rates and foreign exchange, but you need to cover off liquidity. Make sure that you have access to money when you need it. Make sure that you manage your debt and your loan documentation and your loan processes. But again, I would say 15% of companies who are turning over 20, 30 million up probably only have a policy in place. 85% don't. And I don't understand why. Particularly if I was a CFO, I'd want one. If I was a non-exec, I'd certainly want one. Because I'm as responsible as the executive directors and I don't have the same access to information. So that's, again, another thing that it's a simple thing, but it should be done.